Over last weekend, Muskan put out a post asking for questions on Twitter. We got a handful, not many, but let me try and answer some of them. So this is the 24th of April 2023, Monday. And I'm just going over them. Here's the first one. The first question that comes in says high commodity prices leading to sticky high inflation, prolonged rate hikes, private sovereign defaults, bankruptcy, recession, depression, price collapse. Is this how it's exactly going to play out? I think this is sort of, this is one of the narratives in which things can go, but there are a couple of contradictory things in this itself that, first inflation, then deflation, or is it first deflation, then inflation? And we are already past the inflation part. And is the tightening going to be deflationary? Next, will we really do anything which will cause sovereign defaults? I mean, the US is the one raising rates. It's their debt and it's their dollar. Are they going to forcibly put an end to the system? So the answer is no, which means what they really want to do, and that's why I'm spending some time on this, because I think it's a very important question given that there's so much rhetoric out there and a lot of bearish narratives, some of which I'm not saying that the logic doesn't exist. I mean, one of the logics, which I'm finding across the board is that the US will slow down because of credit contractions will contract given what happened with the banking sector, and because deposit rates are very low, money is moving out of banks into money market accounts. The question is how much. We are more than a month gone since all that happened. How much money is moved out of the banks and how much is going to move out in the next 2 months. So a lot of presumptions are there. I know the logic why people should move it out, but are people going to logically take actions? And sometimes people don't. They just like, okay, who's going to put in the effort? And maybe you need that money in the short term. So you will not really go out and, take it out of your bank if the amount is small. So I don't know to what extent, unless it really shows up. I'm not saying it's not a risk. But the point is, okay, banks are going to tighten conditions, they won't lend so much, and that will eventually lead to a slowdown. Now, there's already a slowdown in some segments. The manufacturing PMI, for example, was negative and finally came in positive after several months yesterday. So there are a lot of different data points which you can take as positive, negative. You can think of this entire thing as sectoral and segmental, and also at a global level. This is where it gets interesting, and what I mentioned in my morning post, from the beach as I was recording, that there are two waves. One is this recession talk, which I just described, and the opposite side of that is, and because this is happening simultaneously, right, that China is reopening, it is starting to spend more, cut rates, stimulate, and creating global demand. Now, who does that impact directly, and which is why Europe is close to all-time highs, even as US is just struggling to get off its feet. Because China plays a big role in terms of the economic activity in Europe and parts of Asia. So if you look at charts across Europe and Asia, if I actually do that, so if I simply plug, and I've been posting charts many times in between from some of these markets, if I just open my templates for say Asia or for Europe, so specifically I'm showing Asia here. If I look at Japan, say, it's one long consolidation and it's actually trying to break out of the upside of this consolidation. So it's at the end of something. If we look at China, okay, so if I come down here and I look at what is happening here to China, moving up, trying to take support on a trend line, but it went past this previous high. Of course, we can think whether this rise was 5 or not, but it's pulled back. Will it go up again? Needs to be checked. And then similarly, we do see some impulsive moves. Say in Jakarta, we can see a 5-wave rally from this bottom. Now it may have paused for a while, but the question is it really going to, turn down? So if these are impulsive moves, we can see it here. Simply, we could use the EEM index, the MSCI Emerging Markets Index. And what that shows is that you have a 5-wave advance, after which we are actually pulling back. So this 5-wave here, we've done an ABC. We haven't closed positive yet. We'll see. Maybe today we would, because today's data will get updated only in the night. But if it starts a third wave here, then that would pretty much, clear the whole picture in terms of the emerging market space. So this is the setup for the EM. Now, if we look at Europe, Europe is anyway done better than US, like I said earlier. And if we look at the main countries and specifically CAC, I think FTSE was the first one to cross the 22 high. Now the CAC or the French index has done that, so it's at an all-time high. And why is this happening? If things are so bad in Europe, they're raising rates, 10% inflation, stock market all-time high. How does it all make sense? The reason it makes sense is inflation is at 10%, but interest rates are at 3.5%. So you still have huge negative real interest rates. And at the same time, because of all the stimulus last year when they were still buying bonds, till I think June of last year, that stimulus is also running its course. So all that liquidity is now flushing around. So you have two major factors keeping this market from falling: inflation, which provides the base, and the excess liquidity, which provides the rally. And then the China trade, which is going on. So they're completely different things. And so that's how you explain Europe at an all-time high when US is just getting off its bottoms and trying to get somewhere. And so in that context, how do you weigh this all? On the one side, the China reopening stimulating the world, and US, will it slow down? So is it only a domestic issue, or is it going to be a global issue? And the time usually these things get global is the best way to measure it is look at the dollar. And so is the dollar going up or is it going down? And that then sort of rests the entire argument. The dollar, at least from the peak that it made in September of last year, big fall, small bounce, and then now it is falling again. I've been hoping for at least a minor retracement of this fall, and I'm not even getting that. So imagine my plight. So clearly here again it's been pushing back on the moving averages. If I put this up, you see this red line is the 20-day average. Not able to cross. Again here not able to cross. I thought this time at least it will do so, because the bond market in the US did manage to bounce back a bit and starts going up again. So which means bonds start to rally, yields start to drop. So it had a pullback. At least you had bond yields going up a bit, but the dollar didn't manage a bounce. That's very, very interesting. And what that means is then gold, which I thought would pull back to the fourth wave of the lower degree here at around 1950. Now it's just consolidating here. For all it just stops here and then goes up, and the dollar keeps falling and gold takes off. So this is the setup. This is the bond yields. Like I said, they did bounce back a bit, but are starting to fall again. Dollar is not even bouncing a bit. So tricky situation, but clearly the falling dollar doesn't represent a situation where world markets get affected by what is happening in the US. And what then the markets start anticipating is that because the US may be in the late stages of its hiking cycle, when they start cutting, will it be good? Instead of the cuts being acknowledgement of recession, markets crash, which has been the 2008 and 2000 Y2K and 2008 narrative. That is how it played out. I've explained in great detail in 2 weeks ago in the Weekend with Indiacharts how an inflationary slowdown and a deflationary one, how they are very, very different in terms of market behavior when we look at bond yields and the pivot and that whole story around it. So I'll not repeat the whole thing here, but in short, what I'm trying to say is that too many contradictory forces are at work. So you just can't stick with one thing. You really need to see, okay, if this is happening in the US, is it affecting everything else? And if the answer is no, then, well, what's happening then the other places are going to rebalance the US. So is the US going up with the rest of the world, or is the rest of the world going down with the US? Right now, it looks like the US going up with the rest of the world. It tries to pull back, and every time it halts, believe me, even I start considering the possibility of a correction, but it just doesn't seem to happen. Just like last week, we got a 1 week pullback in the Nifty, but it barely retraced 23%. And then at that point of time, you have to wonder, is it even going to pull back or not? And so this is where I come back to the question that this sounds nice, end of the world theory, but it's not practical. So it may not exactly end like that. And for all if it takes a long enough period of time, let's say a recession to come to the US, the credit contraction and all the after effects take 9 months, then for 9 months, what are the markets going to do? And let's say just US, okay, US does nothing because all this is going on. The other markets will be able to do a lot more, in the meantime, which is sort of what is happening right now, that other markets are just outperforming the US, which is in line with what we saw between 2003 and 2008. The only question is, okay, will it happen for that longer period of time or a shorter period of time? The answer is look at the dollar. So I think I've sort of answered that, and that's one of the most important things in the narrative, I think, today. So there's too much floating around, even forces me to think many times, listen to dozens of interviews, read articles, try to figure out And a lot of people are still thinking the other way. So then I have to weigh, are they right? Because the market doesn't seem to be agreeing with them. And either the market is wrong or they are wrong, or they are just early. It could be a mix of things, and trying to figure that out from an immediate investment and trade perspective has been what I've been trying to do for the last couple of weeks. But so far, in the end, I come back to the conclusion that let's look at the charts, let's look at our markets, what do they show, and they show strength. And so therefore, I'm trying to, my best, trying to put behind this whole narrative that, it's all going to implode. Because that's something I've been hearing for 15 years and it's still not happened. Surely you can say more that clock is ticking and we are late into it. But the only time it happens is the dollar is rising, and that's behind us. And so unless the dollar starts rising again very, very sharply, that won't be signaling that this kind of tightening deflationary environment is really playing out. So far that's not happening. Okay, so what is the downside risk? Well, 16,800 we made in March. I think I've given my view pretty loudly that when it peaked in October of 2021 and a couple of months down that, once we started turning more bearish, I put a timeline which is typically, or at least based on the 2001 experience, that bear market lasted 18 months. So I put an outside time frame. I said, let's put 18 months and see, plus or minus. 18 months meant March of 2023. And sort of when we got into March of 23, all except one sentiment indicators have reached some of the most extreme readings that we have seen in the history of our markets, and not only ours but even US. So despite the negativity around US, sentiment data is also extreme. You have maximum shorts. For example, if you look at the CFTC data, I've actually published I think that chart a while back. Yeah, so here it is, the CFTC speculatives net position, put it in the strategy update section of the site. And this is the this right from investing. You can actually find this data. We ended up with the highest short position since 2011 in the US market. Now either this can be directional or this can end up getting squeezed. It's one of the two. Now since 2008, every short position has been squeezed. So it really comes down to your guessing whether this is like a 2000 or 2008 bubble collapse where shorts get paid, or this is a situation like it has been for the last 10 years where a lot of negativity developed over a period of time, like 1 year, and then after that things just got covered. That's what we saw in 2020, we saw it in 2016, we saw it in 2012, and here we are in 23 looking at the same thing and wondering whether the outcome will be same or this time is different. And so that's but this is the data as it is. So this is just one of them. There are multiple data points that show extreme negative sentiment as far as the US is concerned, and that is what sort of ends up bothering us at the end of the day as in terms of what is happening. But what I really like when I think of Indian markets is this breakdown in the bond yield. I will even tweeted this today, and I've been writing about this since January, when I thought like things look like going too far in India. I mean, it was an expectation in December. I thought that there could be a major decline, but by Jan I started to sense maybe not. Now of course the market was in sell mode. We could have waited a while to do that, but the reason is this, one of the reasons among many. Apart from that, the world market started to recover from Jan itself. The bond yields in India were forming this distributive pattern, which is a triangle structure. And my sense was that, well, if this is occurring now, instead of going to 8%, which would have been a serious risk to Indian equity, and pull down valuations, which is sort of was my thesis earlier, the topping out in the bond yield was a signature that no, that's not going to be the case, which means the valuation base, because I think the COVID valuation low was around 17x as far as the historical PE ratio is concerned. And we've already come close to around 19 or 18.5, something in that range for this cycle. Maybe that's enough. Unless bond yields go up and bring down valuations, that's sort of the baseline for the time being. And now bond yields have reversed, which means we have a top in bond yields, a bottom in the Indian bond market, and the bond market is going to rally longer and harder, which means it could be all of this year. So imagine looking at this chart, I'm thinking like 12 months down, interest rates are going to be lower than where they are today, and they're going to be keep on declining over this period. And would that be a bullish signal or a bearish signal? So that's sort of what got me thinking and wondering. So basically, net, I'm coming back to the question is, I think the worst is over in March, 16,800. Unless there's new evidence that we can actually break that. At the most, what could have happened in the last week, or if US earnings were really bad, you could have had a global pullback and you could have retested that low. But I doubt you will go below the March low unless there's a clear sign that overall momentum is weakening. Right now, there's no sign of that. So I think that's that. 16,500, God knows. So what range do you expect the market to be in the next 6 months? I really don't think about it that way. People like magical answers to magical questions. In fact, there's a saying, in the hedge fund community, if you put a time and price to something, chances are you're probably going to go wrong. So don't put time and price both. If you either put time, like I said, 18 months, did I think it would be still at 16,800? No. If you asked me 18 months back, I would have thought it will be at 14,000 or something. But then the monthly range based on the standard deviation actually keeps contracting over time if you don't fall. And so automatically you cannot maintain the same range. So that range is tightened. It's in fact the lower end is of course 16,200 or 300, but not necessarily you have to hit the lower range. So main point is we don't have a time price thing. I sense worst is over. What would be the upside in a 6-month period? I don't know, but on a 2-3 year period is going to be huge, far higher than where we are right now. And I mean seriously far higher, and I'll not put a number right away. Let me put that in greater discussion in the long short report, though I've already discussed it in last week's Weekend with Indiacharts, Mitesh. So I hope you have watched that. Does God exist and is he really trading? The answer is yes. Even if it was a funny question or Mr. Rohit RK, whatever, unknown face asked a silly question thinking that I wouldn't answer it, or maybe he thought I would. But in any case, I don't consider it funny because markets, in fact, if you think about it a little more deeper, and we are students of Elliott wave analysis, and if you believe that God is God's work, which means the existence of Earth and the people on this planet put together are a God, which means that all of us, represent Him as a whole, and that is the divine force. If you just believe that for a moment, then all our behavior in a net, all our sentiment, all our psychology, which results in our actions, which show up in something known as an index and in stocks in the market, well, that's your psychology. So when you're actually looking at a price chart, you are looking at mass behavior, crowd, and you're essentially looking at God. Is he trading? As a crowd, as a whole, that's what the market price is reflecting. It's reflecting the being himself. So whether you believe that or not, so here I've given you a theory. Can silver hit $300 in our lifetime? I don't know. I'm already 50. So I don't know whose lifetime, because I don't know your age. But can we really hit $300? Let's look at silver spot to answer that question. I'm sure you can hit a big number, but whether that big number is 100 or 300, that is where it can get out of whack. But let's just do an out of whack calculation. Let's believe that after many years of consolidation, this was wave 1. So why not make this a yearly chart? And what you have after wave 1 is wave 3. And on a logarithmic scale, if I say that wave 3, and we've probably only done 1 and 2 of 3 so far. So let's just, annotate a little bit on this. So we have now, this is a yearly chart. We have a 1, 2, 3, 4, 5. We have a massive big first wave. Then we have a massive big second wave. And maybe we've just started 1, 2. We're going on to 3. We're going to see some wild numbers if you do 3. How wild can it get? What if we actually hit equality? That was the main point, right? So if you actually hit equality, if the third wave is even as big as the first wave, you'll end up at $160. I'm saying if. Let's see if it actually works out that way. Now that's not 300, but it is a third wave. And in commodities, exponentiation happens in fifths. But of course, these are massive multi-year things, so I don't know where to consider what. Let's just write the third, uttai kar lo to bahut hai life mein. 300 hoga ka 100, I don't think you'll be less happy at 100 than 300. And the truth will be somewhere in between. So that's sort of my answer. Apparently, I guess after Twitter's gone Twitter blue, this is all the interaction and questions we've gotten so far. And so thank you for those questions. I think I've answered them in a short but long 20-minute discussion on the markets. I'll leave you with this chart, this one of the Nifty. And in terms of what I think may have transpired here, it could have been a deeper, second wave correction, but instead it ended up being short-lived. I think only 23% retracement. And the way I look at it, if something retraces less, it's just a signature of strength, not a signature of weakness. So it's not that, oh, it's less, it should do more. No, it did less. That means it's going to go up even more. It's sort of how I think about these things. So my sense is most probably we did some kind of a second wave. Could have gotten deeper. I would have liked it, but the market doesn't have to do what we like. So we probably did an ABC correction wherein we have an ending diagonal pattern, and we've sort of broken out of this ending diagonal pattern. So I'll presume, unless there's a clear sign that, oh, we have one more dip here, I'll presume that we are most likely headed higher, which means we started the next leg up, and that's what we're going to measure and map from here. Thank you.